Have you ever wondered how lenders decide who gets a loan and at what interest rate? Or how investors decide where to put their money? A huge part of that process relies on something called credit ratings and the companies that provide them: Moody's, S&P, and Fitch. These aren't rating movies or restaurants. They're assessing the creditworthiness of borrowers, everything from countries and states to corporations and even individual bonds. Let's break down what they do, why it matters, and how it all works. So what is a credit rating? Simply put, it's an assessment of a borrower's ability to repay debt. Think of it like a financial report card. A high rating means the borrower is considered very likely to repay their debts, while a low rating signals a higher risk of default, that is, failing to pay back what they owe. These ratings aren't just opinions, though. They're based on a deep dive into the borrower's financial health. Why are these ratings so important, especially here in the US? Well, they impact everything from mortgage rates to the cost of borrowing for states and cities. When a state or city needs to borrow money to fund projects like schools or infrastructure, investors look at their credit rating to determine how risky it is to lend them money. A higher rating means lower interest rates, saving taxpayers money. Conversely, a lower rating means higher borrowing costs. For individuals, while Moody's, S&P, and Fitch don't directly rate you, that's the job of companies like Experian, Equifax, and TransUnion. Their ratings of companies that issue bonds you might invest in are vitally important. Think about buying a bond. You're essentially lending money to an entity, expecting to be repaid with interest. You'd want to know how likely they are to default, right? Credit ratings give you that information. Let's look at how it works with a simple example. Imagine two companies, Company A and Company B, both need to borrow money. Company A is well established, consistently profitable, and has a healthy amount of cash on hand. Company B is a newer company with fluctuating profits and a lot of debt. Moody's, S&P, and Fitch would analyze both companies. They'll look at things like their financial statements, income statements, balance sheets, cash flow statements, to understand their revenue, expenses, assets, and liabilities. They'll also consider things like the company's industry, competitive landscape, and management team. They'll also investigate the specific debt being issued. What are the terms? What's the collateral? What promises are being made? Based on this analysis, they'll assign a rating. Let's say Company A receives an A rating, which is considered investment grade, meaning it's a relatively safe bet. Company B, due to its higher risk, might receive a B or even a C rating, which is considered non-investment grade, also known as junk bonds. Now, investors will see these ratings and demand different interest rates. Investors lending to Company A might accept a 4% interest rate because the risk is low. But investors lending to Company B will demand a much higher interest rate, perhaps 8% or 10%, to compensate them for the increased risk of default. This is how credit ratings directly influence the cost of borrowing. The rating scale itself isn't uniform across all three agencies, but they generally follow a similar pattern. At the top, you have AAA or AAA, the highest possible rating, indicating the borrower is exceptionally creditworthy. Then you have AA, A, BBB, BA, and so on. Anything below BBB, BA is considered non-investment grade. BB, BA, and B are speculative, meaning there's a significant risk of default. CCC/CA and below are considered very high risk and often in or near default. It's important to remember that these ratings aren't perfect. The 2008 financial crisis exposed some serious flaws in the rating agencies' processes. They were criticized for giving overly optimistic ratings to complex financial products like mortgage-backed securities, contributing to the crisis. Since then, regulations have been put in place to try and improve the accuracy and transparency of the rating process. Also, ratings aren't static. They can change over time as a borrower's financial situation changes. A company that was once highly rated could see its rating downgraded if its performance declines. Conversely, a company with a lower rating could see an upgrade if it improves its financial health. These changes can have a significant impact on the borrower's ability to access credit and the cost of borrowing. So, in a nutshell, credit rating agencies like Moody's, S&P, and Fitch play a crucial role in the financial markets. They assess the creditworthiness of borrowers, providing investors with valuable information to make informed decisions. This impacts everything from government borrowing costs to individual investment choices. Understanding how these agencies work is essential for anyone involved in the financial world. They provide an independent assessment of risk, helping to ensure that capital flows to the most deserving borrowers. While not foolproof, they are a vital component of a functioning financial system. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.